Hey, y'all, welcome to the Texas Blockcast. We're here today with Ben Harper, Associate Director of Derivatives at Luxor Technologies. He's calling in from Calgary, Alberta. Alberta sent a trade delegation down to the summit a few months ago to just brainstorm, participate, engage in the industry. They are the Texas of Canada, or as some might say, Texas is the Canada or the Alberta of Canada. So Ben, tell us a little bit about your background. I know you studied finance and economics. You've got extensive experience in that space. How did you end up where you are at Luxor today?
Yeah, well, first of all, Lee, thanks so much for having me on the podcast here. It's great to speak with you. As you mentioned, we were down in Austin. It was my first time down there. I've been to Dallas a few times, but first time to Austin with that trade delegation you mentioned, and we had a fantastic time and tons of brainstorming and really learned a lot from what you guys are doing. As you mentioned, and just for everyone listening, my title at Luxor Technologies is I'm Associate Director of Derivatives, which is a new business line we've just recently launched, and we can touch on that later. I'm also on the mining and policy committee for the Canadian Blockchain Consortium. So, trying to replicate some of the good work that you've done down in Texas up north here. And in terms of my background, a little bit all over the place. I try to do a little bit of everything, but it's mostly been finance and economics focused. Like you said, studied finance and economics in school. Out of school, I did the investment banking thing. Worked for National Bank Financial in Toronto as part of their diversified investment banking team, where we covered power and utilities, consumer products, industrial products, and real estate. And then after that was on the equity capital markets floor briefly, working on equity issuances for different public companies on the Toronto Stock Exchange. Then flipped over from the private sector into the public sector, did a master's degree at Columbia University in New York. I did a brief stint over in the Middle East, working in the Jordanian Royal Court in the economic and fiscal affairs team there. Did a brief stint for a consulting firm back here in Alberta before joining the government here in Alberta, the provincial government, which would be the equivalent of your state government. I served in that government. It would have been last year and the year before. Served as a policy advisor for the Minister of Treasury, Board and Finance, which would be the equivalent of your treasurer, and the premier, which is the equivalent of a governor in the United States. And had enough of the political thing. Got some good experience, particularly during the COVID crisis. Alberta was uniquely impacted, not just because of the virus itself and the economic activity that it took with it, but because the oil price crashed. So there were some very particular fiscal pressures on the province. And got out of the political side, want to come back to the private sector, was looking at, maybe going to consulting, back into banking, a bunch of different things, and had an old friend, Ethan Vera, who people from the mining community might be familiar with, reach out and tell me about Luxor and what they were doing and what they were looking to do to build out their derivatives desk. So I was brought on board to help build out the derivatives desk and also do a couple other things at Luxor. But now I'm working at the derivatives desk at Luxor, which is really the first of its kind, and excited to tell you more about that. And working with our head of derivatives, Matt Williams, who is a third generation trader out of Chicago. He worked for the CME, the NFA, has a past in options trading and energy trading, and he even helped launch the Bitcoin futures product on the CME exchange. So extensive background, and the two of us, and we're currently looking at expanding our team, are really running the derivatives desk at Luxor, and excited about this new product and really the maturation of the Bitcoin mining industry. But that's really my story and how I got involved in this.
And we want to get into more details about y'all's derivatives products. But before we do, I think most listeners will be familiar with Luxor, but just in case they're not, Luxor is a Bitcoin mining software and services company. They operate a mining pool. I personally have my machines. Few that they are. I wish they were in the thousands. They are not. But I have my S19s, sending their hash power to the Luxor pool, and I get obviously I'm stacking sats through that method, and just generally well thought of company, doing it the right way, doing it and maybe a way that would seem methodical. But that's how you have to be in this industry. Hash rate is a commodity. Machines are a commodity. and you can't just get out over your skis. And so Luxor's earned a lot of respect by being very methodical in their processes. Okay, so this derivatives product that you guys are developing is very important for the industry. Steve Kennard, the TBC's director of Bitcoin mining analytics, is quick to tell me and remind me that in the oil and gas industry, you don't get investment capital unless you're hedged. And in the Bitcoin mining industry, it should be the same way, right? We should see lenders start to require hedging as a precondition for investment. So do you expect that we are close to that? Have you heard rumblings of that? Is that why you guys started this product? Because eventually it's going to be a requirement, or maybe not a official requirement, but a de facto requirement?
Yeah. So, I mean, first of all, the way we view this, and just kind of take a step back, the way we look at this, I think you mentioned, is commodity. At Luxor, we see hash rate as a commodity. It is a new native digital commodity.
Yeah.
Bitcoin miners we see as producers of that commodity, and we believe at Luxor that they should have access to the same suite of financial products that allow them to de-risk and to optimize their operations that producers of other commodities have. And like you said, Lee, and like Steve from TBC has often pointed out, this is the standard in the oil and gas industry, in agriculture, in electricity. And so, we're not reinventing the wheel here, but we do have a new asset class. And we believe that just, basic first principles is we want to be the ones that build those financial products for miners specifically, so that they're able to employ hedging strategies. They're able to have some certainty into their business planning. And then hopefully that will help facilitate access to capital. We just, as we see this industry mature, the operations get larger and more sophisticated, the integration with the energy sector becomes greater. That's the direction we see this going, and that's why we really launched this product. Is we think this is a commodity producing business, and like any other commodity producing business, they should have access to the financial products that help them, make their operations more efficient.
Amazing. It's tough to launch a product like this in a market where people just wish they had been hedging, a year ago, and now some of them are in a position where they don't think they can afford to hedge. What would you say to that if that comes up in a conversation?
Yeah, well, obviously capital constraints are a big topic in the industry. And particularly right now, and you're absolutely right. Of course, looking in hindsight, and hindsight's always 2020, it would have been better to hedge out before the drawdown than after. But the reality is a lot of these products didn't exist before the big drawdown. In particular, our product, which was only launched in beta phase in October and in standardized kind of non-beta phase in January 1st, only 20 days ago. So I don't think miners really had the opportunity to employ some of these strategies and to hedge the way that they would. I know that there's, for example, Bitcoin futures, which are a valuable hedging instrument, but of course, miners on the revenue side are exposed to more than just the price of Bitcoin, right? Miners are exposed to what we call at Luxor hash price, which takes into account 4 variables, right? There's your Bitcoin price that you're exposed to, there's your network difficulty you're exposed to, and also transaction fees and the block subsidy. And so, when we looked out in the market, we saw that there was Bitcoin futures, but that's really not a product that's specific to miners that looks at the risk exposures they have on their at least revenue side. They have power purchase agreements that can hedge their cost side. The Bitcoin futures are great for hedging part of your revenue and definitely your balance sheet. But we wanted to launch a product that allowed miners to really lock in on the cash flow portion of their businesses. And so, we're, as a mining pool and as our content site we call Hash Rate Index, I should say, or plug it there as well. We really see hash rate as a commodity at Luxor. And we have an index where we value, it's called our hash price index. We take, if you have 1 petahash of hash rate, how much can you expect to earn in a 24-hour period? That's up live on our website. And as a mining pool, we're really the spot market for hash rate. And so that's the way that we view it. That's the way that we see it. And so, hopefully with this product now, hindsight's 2020, capital is constrained. Those are obvious concerns and totally get that. But our view is that looking to facilitate that access to capital in the future. Like you said, hedging strategies I think will be very important, and particularly with the you could say it's even carnage in the blockchain space. There's not a lot of capital. I think capital coming going forward, at least for the next little bit, will have to come from outside the sector. One area that looks promising to me is the energy sector, particularly with the higher energy prices that we're seeing in the energy bull market. There's more capital in that space.
Yeah.
And we think that a hedging product like this, which is analogous to what people in that industry are used to seeing and being really a prerequisite for facilitating access to capital, I think that a product like this that we have that allows you to de-risk your operations in such a volatile market will ultimately help bring capital in. But of course, it is tough times out there, and we want to build products so that in the next bull market, we can be in a better position and hopefully, kind of lessen the hurt that's out there in the next bear market.
It makes sense. I've heard you describe how this works, and I think for those that are not traders that haven't grown up with understanding commodity markets, it might be helpful. And secretly, I kind of want to hear you explain it again because it's not the most digestible of concepts. Could you explain how it works from start to finish on the buy side, on the sell side, what it looks like? Yeah.
So just kind of take a step back again, starting and just kind of looking at the product. Again, we see hash rate as a commodity. We want to build the entire suite of products that miners can use. And when we looked at what was available, right, there's power purchase agreements on your cost side. You have Bitcoin derivatives that help you hedge your treasury and your holdings. But there wasn't really much on the revenue or cash flow side. We saw a small patchwork of what's called physically delivered forwards that were out there. There was Bitcoin futures, which existed. And so we wanted to do something hash rate and miner specific. So like I said, we have this hash price index already as part of our site. And that's kind of the first thing to understand is that there's an index for what you're earning as you're mining. And that's what you can expect to earn from your mining pool. And so our derivatives products are based around that index. The first product that we decided to launch it's called a non-deliverable forward. Okay, and so a forward is really your most simple type of derivative, although derivatives, of course, are a complicated topic. And what a forward is it's just an agreement between a buyer and a seller to deliver a pre-agreed quantity of a commodity on a future date at a fixed price. And there are typically two types of forwards. One is called a physically delivered forward, which you actually deliver the commodity physically to the seller. And then the other type is called a non-deliverable forward, where instead of actually delivering and paying the full purchase price for the commodity, what you do is you pay the difference between the final market price of that commodity and the pre-agreed fixed price. That delta, that difference between those two prices, is paid from the buyer to the seller if the price of the commodity falls, and from the seller to the buyer if the price of the commodity rises. And so, there's pros and cons to physically delivered and cash settle. We decided to stick with cash settled just because it's the kind of simplest, easy to use, and we believe it'll bring more liquidity into the sector. Part of the problem with a physically delivered forward, and these have been tried before in the mining space, is external capital doesn't quite know what to do with physically delivered hash rate. Imagine you're an investment firm in New York or London. You would much rather not have to actually take delivery of hash rate, and that's what you see in derivatives markets. Just kind of generally, the cash settle markets tend to be much larger, but of course there are drawbacks, and in terms of upfront financing and things like that, which physically delivered forwards can meet. But for us, we started with what's called a non-deliverable forward, and that's sort of a complicated explanation. Apologize, but there's just kind of the background. Now, our product is fairly simple. We match buyers and sellers along three variables. Our contracts are really just three variables. There's what we call your unit hash price, which is that pre-agreed fixed price that we were talking about. So if you're a miner, you're able to sell forward at a pre-agreed fixed price. There is the daily hash rate that you're putting under the contract. And then there's the number of days that you want that contract to run. In terms of the hash price that you can pre-agree to, we have two different classes of products. We have our US dollar denominated product, and we have our BTC denominated product. The BTC denominated product protects you in terms of your exposure on the network difficulty and transaction fee side, whereas the US dollar contract sees protection as well on the Bitcoin denominated price, and different miners with different obligations and different strategies use those products differently. In terms of the durations, we have standardized monthly contracts that run 1, 2, and 3 months forward. But we also have the ability to put together custom contracts. The only real limiting factor is our ability to match buyers and sellers amongst those 3 variables that I mentioned. And then, of course, at Luxor, on top of matching buyers and sellers, we also manage counterparty risk. So you face Luxor when you're trading these products. You don't have to worry about tracking down the buyer or the seller on the other side of the trade. All parties face Luxor. We also have a position manager tool where you can monitor all your trades, your profit loss, keep track of charts and things like that. We act as the settlement agent as it's settled to our index, and we also take care of all regulatory reporting. This is a CFTC regulated product, so we take care of all reporting on the Luxor side, and that's kind of the broad overview of the product. We can get into how miners and investors are using these products, but that's kind of the broad overview and the rationale of how the product came to be.
That's amazing. It's incredible the level of sophistication that we're getting to in the Bitcoin mining space, and we need to be there. It's just happening much more quickly than in commodity markets in decades past. And that's probably just a function of the compression of time. There's that great book, Thank You for Being Late, about the amount of change that we see in a year is the same amount of change that the greatest generation saw in a decade. So we do have a compression of time due to this technological advances and to Moore's law and all sorts of other things. So it doesn't surprise me that we're advancing this fast, but it's really cool to see that Luxor is the one that's leading the charge here. So let me just go back. You said something that you could settle in dollars or Bitcoin. So if somebody has like a Bitcoin denominated loan as a miner, in that case, would they want to hedge in Bitcoin?
Yeah, so that's typically where we're, if you're seeing a miner use, and when I say, miner and hedger, typically what we're seeing is if you're hedging your revenues, you're selling these products. And so typically what we would see, right, is miners are hedging in the currency of their obligations, right? And so just like you said, why would someone use the Bitcoin? So there are miners that have Bitcoin denominated obligations. And so what our product allows you to do is sell forward at a locked in hash price in terms of Bitcoin. And so you can get certainty in terms of your production of Bitcoin, regardless of what transaction fees and network difficulty end up being.
It's amazing.
And that's really the mechanism where it helps you facilitate access to capital, right? Is because if you can have certainty about what you can produce and the price that you're going to produce it for, then lenders, investors are more likely to participate.
It's an absolute game changer. Now, who's taking the other side of the trade usually?
Yeah, so we have a very diverse set of market participants, and like you're alluding to, and for people that might not know, in a traditional derivatives market, you have 2 sides. You have your hedgers and you have your investors or speculators, sometimes they're called. We're seeing on the buy side some really interesting things happen. So like you said, you have your traditional kind of buy side finance firms, crypto hedge funds, different kinds of investors coming in. We're also seeing quite a bit, and this is, I think might be interesting for Texas specifically, is we're seeing quite a bit of buy-side liquidity come from hosting companies. And that's a really interesting use case that we didn't necessarily see when we designed this product. But if you're a hosting company, Lee, what you have to remember is that you have, instead of your revenue being denominated in hash rate and hash price,
that's
your obligation. Your obligations are in hash price and hash rate. And so some of these companies will make uptime commitments to their hosted clients. And when they're shutting down because of the spike in energy prices and participating in demand response, for example, What our product allows you to do is hedge out your costs. And by becoming in on the buy side, the opposite side of a traditional mining hedge, the buy side, you're hedging your costs. And while they're shut down, right, they're exposed to run-ups in the price of Bitcoin or drops in network difficulty. And so our product allows them to lock in their costs and be a hedger, but on the other side of the trade from a regular miner, let's say.
That's amazing. So put that in the context of like a Texas. Why is that more important in Texas? Because you mentioned some words there that I want to call out. Demand response, if someone's got some ancillary services obligations. Talk a little bit more about how this provides them more certainty as a hoster.
Yeah. So, like you said, one of the, and just taking a step back, one of the advantages of Bitcoin mining and why it has so much potential to stabilize the grid, incentivize renewables, even when we're talking off grid and capturing methane emissions, is that it's a completely location agnostic interruptible load, and particularly that interruptible side is really important because it has flexibility that other load resources just don't have. And so, some hosted miners, for example, will make commitments to their clients in terms of how much uptime they will have for their Bitcoin production. But of course, as you know, there are times when miners in Texas need to shut down so that the rest of the grid can make use of that energy, particularly around the winter, when everyone's using their air conditioning in the summer. It can become uneconomic, or there might be better economics in participating in demand response programs for the hosted company. But however, what you have to remember is if you're shutting down your mining operations, you do have an obligation to your client in terms of paying them what they would have expected to earn in terms of what hash rate economics are. And so by buying our product, it essentially hedges you. You're taking a long position on hash price. And so since a hash price is a cost for these hosted operators, by buying our product, you partake in the upside of hash price. So if hash price goes up, your obligations to your mining clients also go up. However, you would be profiting off of our contract, and that's how it acts as a hedge. Is it kind of layers on top of your operations, and as long as you set the parameters right to what you need, it can act as it's essentially a swap. You're saying, look, I'm willing to give up downside in terms of my hash price to be able to capture the upside, so that I can make sure that while I'm shut down and I'm participating in demand response, I'm still able to meet all my obligations to my hosted mining clients.
Yeah, I want to make sure everybody understands how much of a game changer this is, because the conversation has always been, if you're aggressive and bullish, you go into mining. If you're conservative and you have conservative investors, you go into hosting. And so this really flips that narrative on its head and saying, you can do either. You can be a hoster and be bullish and be long and take part of that upside and that volatility, or you can be a miner and be just commodity-centric, hedged, modest, returns, or you could be somewhere in between.
Absolutely right. This is just a tool, and I think what we'll see is the strategies that miners are able to employ will become more and more sophisticated. I mean, as these are, Lee, you spend a lot of time with the miners. These are brilliant people, and they'll find even more complicated, even more efficient, better strategies, I think, with a tool like this to employ than we can think of. But it definitely unlocks, what's available to other sectors, allows you to employ a bunch of different hedging strategies and really optimize your operations in a way that wasn't available before a product like this existed.
So what's on the horizon? What's next?
Well, like I said, I mean, I can't say too much, but just like our thesis here, right, Lee, is it's pretty simple. We think this is a new commodity, and it needs all the same financial products exist that in other commodities. So we're not reinventing the wheel. We believe this is a new asset class, and we want to provide the same tools that other commodity producers have. And so, whether that's physically delivered, whether that's options, they're all on the table right now. And we're having conversations with miners in Texas, in Canada, all around the world, trying to get a sense of what works best for them, and that'll be what's next. But really, I mean, we want to have the whole suite of products here. We want it to be hash rate specific so that miners have a tool available that's specific for their operations.
So it's amazing. It's absolutely amazing. And I think you guys are on the bleeding edge of this. I wonder what the TBC can do and what others can do on the front, because obviously we've got these lenders that have extended themselves that are Bitcoin native lenders, that they're probably not looking at making new loans, new sizable loans, but there's going to be traditional lenders that come in that are going to be providing financing to this industry. And I'm thinking that's who we need to convince, right, is the traditional lenders. Because I doubt that and I don't want to say any names, but we all know kind of who I'm talking about. There's some companies out there that are not going to get burned again. All right, they're probably already talking to you, but they don't have as much capital to deploy right now because they've been burned over the last 9 months. I'm wondering if the next conversation, and you guys are probably 10 steps ahead of this, you're already talking to these banks, but the traditional lenders probably don't need a lot of convincing because you've just shown the playbook of why this is needed.
Yeah, and we've gotten very positive feedback from those conversations that we've had, and I also should mention, like, those are the type of companies that are also participants in this market, right? Because this is a tool for them as well, right? They're making loans. They have positions in companies that are long hash rate, and so a product that allows them to go short hash rate allows them to effectively hedge some of their exposure to those lending contracts as well. So it's not only a tool for miners that I think lenders and financiers will see that's attractive, but it's also a tool that lenders and financiers are using and looking at using as well to de-risk their own investments. So hopefully that helps bring more capital in the industry, because really that's what's needed right now.
Yeah, it is. Well, let's add a little levity here and think about kind of this friendly rival we have between Alberta and Texas. It's more of a co-opetition, I think.
Yes.
If Alberta and Texas were to get into a boxing match, who do you take?
Well, I'll say, okay, well, I'll give a politically correct answer. I'll say if it was just everyone in Texas versus everyone in Alberta, I'll give it to you guys because of the population difference. I believe Texas is about 29, 30 million, or I guess maybe 20, 25 million people.
About there, yeah.
Alberta's only 4.5 million, but anything per capita, I feel pretty confident that Alberta would pull out on.
There you go. That's a great answer. Great answer. Okay, so as the mining industry faces, I guess, what I'll call unprecedented challenges, because they're probably there's precedent for it, but we're at a much bigger scale right now than we were when these challenges arose, 4, 5, 6 years ago. What are you seeing in Canada that we need to look out for here? I was reading an article the other day about, I think it was one of the southeastern states, I don't know, Kentucky or South Carolina or something like that, where there were citizens of the state that were organizing against a mining farm and they were like local people. They weren't just like people driving in from the city, saying, "Oh, we should." They were local people, and they were arguing. They're organizing against the mining farm because of the noise. And we know that a lot of mining in at least south of, call it south of Nebraska, is going to go to immersion, and probably even in the colder climates too, just because of the way you can regulate the temperature of the machines. So that's not as much of a factor, but are you seeing that kind of opposition from like the grassroots? Because we haven't really seen much of that in Texas. Most of it has been kind of just journalists or elites in different parts of the country stirring up. But this was the first time that I saw it from like a rural constituents, because normally the rural constituents are like, heck yeah, we're bringing new jobs, we're bringing tax revenue, we're bringing new roads, new infrastructure, bring it on. But are you seeing that a little bit in Canada, in Alberta?
Yeah, I mean, nothing particular, nothing specific like that I'm seeing, but I think like the broad conversation that we're having in Canada is very similar to what you're having in the United States. You have really different perspectives state to state. You have national governments that are, let's just call it a little more skeptical, and I think we have a little more work to do there. Yeah. you know, in terms of, it's almost a mirror story, really. You have states like Alberta and Texas, which are really trying to embrace the sector, finding ways to take advantage of this new technology, make their energy systems more efficient, capture stranded methane. And then there are, states that are taking the complete opposite approach, like New York or Quebec, which are placing moratoriums on new mining operations. I think, like, when I look at this, I think there's a in the sector, there's just a natural inclination to criticize the government, which I think obviously is fair enough. I could sit here and criticize particularly the Canadian governments all day. But I do think it's incumbent on us as an industry, right, to make sure that we're doing things the right way. Like we all know that if you're placing a mine in the middle of a residential area, and of course nobody's really doing that, but if you are, then there are real noise concerns and things like that can impact other people. And I think it's incumbent on us to really do things the right way, to engage with regulators, to engage with people, to tell people that the potential for this. But I think it's incumbent on us as an industry to do things the right way, make sure we're getting our message out there, make sure we're selling our benefits, and make sure we're addressing some of people's real concerns. And noise concerns are not just specific to Bitcoin mining, but one bad actor can make a bad name for an industry. So I think it's incumbent on us to develop ways to do things the right way, work with industry associations like yourself that do a fantastic job representing the industry, talking to communities, talking to local regulators and legislators. I do think that we have to make sure we're doing things the right way, and I think that's by far the case. But we can always do better, and I always like to not place blame on others, but kind of internalize and improve ourselves. And I think that we can do a little bit better as an industry. And I think, ideas, these are just brainstorming, but ideas like, maybe developing what we've talked about in Alberta is an operator's code of conduct, having some, self-imposed regulations in terms of, decibels, in terms of noise, so we're not impacting local communities. And that can be something that we can do as an industry. We don't have to wait for government to do.
Wise words. Yeah, it's always better to self-regulate than have a regulator who means well but doesn't have the same nuance come down and bring the hammer.
Absolutely. And as you know, on noise, and you've probably been to a bunch of mines, there are ways to reduce noise. There are ways to do things properly, and most miners are already doing it. Yep.
Well, Ben, this has been a fascinating conversation. I kept you longer than normal and longer than I should have. I know you've got things to do, but thanks for sharing this with our audience. Where can they go? I'm assuming we just send them to y'all's website, Luxor's website, to find more about these products.
Yeah, Luxor.tech is where you find more about Luxor. If you're interested in learning about our mining pool or our newly launched firmware that's going to be coming out. If you're interested in just Bitcoin mining content generally, Hashrate Index is the place to find that. It's our content website. And then if you want to learn more about derivatives, it's luxor.tech/derivatives. And you can find me on Twitter at Ben_S_Harper.
Perfect. Thanks, man.
Yeah, thanks so much, Lee. Really appreciate it.
If you want to be part of the future that we are crafting here in Texas, join the TBC today.
Hey, it's Amy. Click over here to subscribe, click over here for more content, and we'll see you next time.